Hello everyone. Today's topic, options in stock market. Options are a type of derivative and hence their value depends on the value of an underlying instrument. The underlying instrument can be a stock, but it can also be an index, a currency, a commodity, or any other security. So there will be an underlying asset or underlying instrument. So according to the movement of the underlying instrument, the price of the option will also change. The price of the option, depending upon the underlying instrument, will increase or it will decrease. What are options in trading? So let us understand how can we trade in options. Let us say that the stock for XYZ company is at rupees 250. If an investor is bullish on the stock, means if the investor expects the stock price to go up, he may buy a call option with a strike price of rupees 260. So if a investor wants to buy an option, he has to decide the strike price. So without deciding the strike price, he cannot buy an option. So he can buy the option of the strike price which is higher than the market value or which is lower than the market value. So in this case, he decides to buy the option of a strike price which is higher than the market value. So it is rupees 260, the strike price. For that, he will have to pay a premium. So the rate at which he buys the option is called premium. Let us say that the price of the stock of XYZ moves up to rupees 280. So he has bought the call option. So when you are having the call option and the stock price increases, you will be making a profit. So suppose that the price at which he bought the call option is rupees 10 and the lot size is 1000 shares. So now the stock price has increased from rupees 250 to rupees 280. The price of the call will also increase. So it will become from rupees 10 to rupees 20. So he will getting a profit of rupees 10 for 1000 share. So his net profit will be rupees 10,000. So now let us see how one can trade in put option. If a trader is bearish about a stock, he can buy a put option. Means if the trader expects the stock price to decrease, he can buy the put option. Let us say that the share of XYZ company is trading at rupees 250. If an investor buys a put option for a strike price of rupees 240 and if the stock price falls to rupees 220, the trader can make a profit, because when you are having the put option, you will make profit when the stock price decreases. So the stock price has decreased from rupees 250 to rupees 220. So he would have bought the put option at rupees 10 and the lot size is 1000 shares, and now the put option will become rupees 20. So he will get a profit of rupees 10,000. So what are the types of options? The types of options are call option and put option. What is a call option? A call option is a type of option contract which gives the call owner the right to buy a security at a specified price within a specified time frame. So in call option, because the trader is having the right to buy, when the stock price increases, he will be making a profit. So bullish traders buy call options. Put option. Put options give the option holder the right to sell an underlying security at a specific strike price within the expiration date. So because it is the right to sell, when the stock price decreases, a put option trader makes the profit. Moneyness of options. So depending upon the moneyness of options, we categorize the options as in the money options, at the money options, and out of the money options. It is also called as ITM, ATM, and OTM. Suppose the stock is trading at rupees 400 and we buy the same stock with the strike price of rupees 395. Now the strike price is lower than the market price. So this is called as in the money call option. Now let us suppose that the market value of the stock is 400 and we are buying the call option of strike price of rupees 400 itself. So it is called as at the money call option or ATM call option. Now let us suppose that the strike price of the call option is rupees 405 and the market price is 400. So we are buying a call option with the strike price of 405, then it is out of the money call option or OTM call option. Now let us come to the put options. Let us suppose that the stock price is 400 and we are buying the put option of rupees 395, then it is out of the money put option. The stock is trading at 400, we are buying the put option of 400 strike price itself, then it is at the money put option. The stock is trading at 400 and we are buying the put option with the strike price of 405, then we are buying in the money put option. So there are three types in call option and there are three types of in put option. Now what are the features of an option contract? Premium or down payment. So when we buy a call option or put option, we have to pay certain amount. It is called premium. Next feature, strike price. So we will have to select a strike price to buy an option. So in the example what we saw, the stock price was rupees 250 and we bought a call option with the strike price of rupees 260. That rupees 260 is the strike price. So we'll have to select a strike price to buy the option. Contract size. The lot size is the contract size. The premium, that is the rate of the option into the lot size, will be the value of that option. In the example that I had given, the premium for the option was rupees 10 and contract size was 1000 shares. That is why the value of the option was rupees 10,000. That lot size is called contract size. Expiration date, or it's also called as expiry. So for stocks, the last Thursday of every month will be the expiration date or expiry. And for indexes like Nifty and Bank Nifty, the expiration date will be the Thursday of every week. So every Thursday there will be an expiry. So the options for Nifty and Bank Nifty will become 5 paise. That means they will almost die on every Thursday. And for stocks, on the last Thursday of every month, the values will become 5 paise if the value of the, that is market price of the stock, does not cross the strike price. If it crosses the strike price, then it will be having a good value. Only if it is lower than the strike price, the option will become 5 paise. Advantages of options. Low cost of entry. We can buy the options at very less cost. Why we are saying it less cost? Because we can get that huge lot size, just like the futures trading. So the lot size in the futures, same will be the lot size in options, but we can get all this lot size at a very less cost. And we can, if the stock price increases, we can get substantial profits. Hedging against the risk. So many people use the options for hedging. Some traders will be having many futures long positions. Suppose they are having they have bought the futures of Reliance, Infosys, TCS, etc. And if the market falls suddenly, they will incur huge losses. So for that, what they do is they buy the put option of the Nifty. So even if the market falls, the losses they make in the futures of Reliance, Infosys, TCS, etc., they can recover that to some extent by making a profit in the Nifty put option. Disadvantages of options: lower liquidity. So compared to equity, the number of shares buying and selling will be less in options. So in options of some strike prices, the liquidity will be very, very less. So that could be a problem for the traders. So when they want to sell, they may find it difficult to find the buyer. Risk. So there is always decrease with time in options. So if it is a monthly contract, when the option comes closer to the month end, the price of the option will decrease drastically, and this could cause substantial losses for the trader. Complicated. So there will be many factors that affect the options price, because whenever the stock price, underlying instruments price moves, the price of the option will be affected. It will increase or decrease. And also, as the days pass by, the value of the options decrease. So, and when there is short build-up in the option, then also the price of the option will decrease. So a trader will have to analyze all these factors while he is trading in the options. So it makes his job very bit difficult, because he should be having a lot of experience and skill in trading in these options. So this is all about options. Thank you.